There is a substantial risk of loss associated with trading forex, binary options, stocks, or equities, collectively, asset classes. Only risk capital should be used for trading. Trading in any asset classes is not appropriate for everyone. Past performance is not necessarily indicative of future results. No representation is being made that investors will make profits, or will not sustain losses. Before trading in any asset classes, investors should consult with their professional broker, financial advisor, or financial consultant to determine whether trading asset classes is appropriate. Investors who trade in any asset classes should only do so if the capital used for this purpose represents funds that an investor can afford to lose without adversely impacting the investor's lifestyle. No trading strategy or methodology is without risk of loss. No trading strategy is risk-free, and no trading strategy can guarantee profits or freedom from losses. Investors risk losing the cost to execute any transaction, including associated commissions or fees. You should carefully consider whether trading in any asset class is appropriate for you in light of your investment experience and financial resources. Any trading decisions you make are solely your responsibility and at your own risk. None of the statements or materials in the Auvoria Prime chat rooms constitute a solicitation or recommendation to buy or sell.
Steve Vetterl on the microphone, talking about global macro issues for the Auvorian subscribers. Welcome. Again, we are in the middle of the month, the first month of the third quarter, July, August, September. I talk a lot in quarters. I always suggest, especially as a trader, you learn quarter systems. You can dial them back and forth because a lot of expirations occurred during Q1, 2, 3, 4. In some cases, it's a quad-based expiration. So what I'm going to try and do going forward a little bit different is try to have like some different lines, some different sayings, some stuff I come across. This one was actually really good, and have it sort of be the theme of the discussions. So you guys have probably heard this in many different forms, but I like this one. It basically says, if you're not looking at the screen, a key to surviving in the highest competitive pursuits is recognizing that failure hurts far more than success brings joy. Okay. Now, if I was to break this down and define it, more can be learned from failure, much, much more than from success. So, as I often tell my kids, there's nothing wrong with doing something incorrectly, right? The stupidity that comes from it is continuing to do the wrong thing and expecting a different outcome, right? So there is so much risk management rooted in this discussion. I could talk for an hour, and I don't want to bore you guys on this because you've all probably heard this before. But I always, in the very early days, this is back in like 2001, 2, where I sort of really started learning how to trade both options and equities. Really sort of cut my teeth in the summer of '97. Basically getting really lucky buying options on Dell Computer when it was ripping up 5 points a day. So I thought I was God's gift to trading. I learned very soon in 1999 into 2000 that I was not God's gift to trading, as many of those positions got into the complete wreck and the bottom of the tech market in 2003. Just really took a toll on me as I kept trying to catch a falling knife. It's really when I started to learn much more in depth of how to pay attention to charts. Simple charts, price action, support, resistance. It wasn't until about 2008 that I caught on to market profile, which was really gaining some serious steam among the futures crowd, so forth. So, but just always take notes of things you do wrong is really the moral of the story here. Learn from what you're doing wrong. Let's move into the Forex calendar. Make this a little bit easier to see. Always check your dates. I only look at red folder events for next week. The key thing really is right here in terms of importance on Wednesday. Remember, this is East Coast. I am Florida based. Do check these time zones for whatever time you have across. Just make sure we're streaming okay here. Very good. So The thing I thought was interesting when I looked at some of these readings and trying to decide, sort of what's the game plan for next week from the standpoint of a forex trader or really any traders. You always want to be aware of the news, obviously, but when you're looking at news stories, you always want to take a look at it from sort of the perspective of what's the hot topic, right? And right now, obviously, it's inflation. So inflation's happening mostly across the planet. I must say kudos to everybody in New Zealand. Maybe it just hasn't hit yet, but there's basically no inflation in this country, which is totally cool. So for these, I know we have some subscribers in New Zealand and Australia. That's certainly good to see. It's not the case in the rest of the planet. In most cases, it is a problem. So it's coming about. We got some releases from both Canada and the UK. That's what I would spend most of the time worrying about. This is going to be very interesting. The ECB press conference. Honestly, with as touchy as these markets are, I really don't. I mean, it's like anything that goes wrong, everybody goes flying in the dollar, and every other currency goes down for the most part in major land, right? That's absolutely what's been the case. But at some point, I'm pretty sure that boat is just getting ridiculously loaded. For some of you that do not know who Tom DeMark is, you can certainly Google him. I would not suggest reading any of his books. You will be lost in chapter 1 like I was. This guy is a genius. He's developed some of the best countdowns and sequential setups on charts that I have come across, period. His stuff and his indicators are exceptionally expensive. They can only be had through CQG or a Bloomberg terminal, which costs anywhere between $900 to $2,000 a month. So for all of you wondering why Michael Bloomberg is so loaded, you now know. No, you don't get much of a discount if you own a big trading firm. So all you get out of that cost is the damn keyboard. In any case, so why does it matter, Steve? Because the yen is on an absolute TD sequential countdown 13, which basically means in fifth grader terms, it is so ridiculously oversold that is due for a rally. Now, I know not everybody necessarily trades in the yen, but I thought with some of my DeMark trader buddies, especially Tommy Thornton, hedge fund telemetry, hats off to him. It was his alert on this on Friday. So does that mean that the yen is all of a sudden going to start ripping up and the dollar down? I don't know. All I'm saying is it's just ridiculously oversold. So with that being the case, that's really all I have to say in Forex land. I'm going to skip the FinViz charts. We're going to go right to the charts. For those of you trading US 30, which is the Dow, do keep in mind I find this to be an exceptionally inefficient benchmark. It did rip big on Friday. Do understand these comprises the 30 largest companies by not capitalization. Okay, so just remember that. This is why I always favor the S&P. It's a broader index. It is the main benchmark on this planet as far as equities, especially for US-based equities. But many of the companies that comprise the S&P are global producers. So, Dow 30. Look at the S&P. Charts are almost exactly the same. Where it is different is between S&P and NASDAQ. So I don't really show NASDAQ too much because I think more of our subscribers trade Dow 30 and S&P as opposed to the NASDAQ, but whatever. So we are in a tight range. We've had some oversoldness, almost everything that has to do with any movements in equities land or currencies is all hinging on what central banks are going to do to quell inflation, right? What are they going to do to push it back down? There are many, many different schools of thought. Many disagree with the others that think they know the plan, right? That's why Twitter is an absolute buzz with everybody that's got an opinion. My opinion is if you take a look at the charts of commodities, many of them are in the toilet. I've talked extensively about this. I'm not going to drone on about it. I just don't see, yes, inflation exists, but I'm not seeing why these readings are coming in. Maybe I'm a dope and I'm missing something, right? It's possible. Been paying a lot of attention to our startup and much less to this stuff, as you guys may know, right? But most of these commodities are in the toilet. So if their prices are that low, where the hell is this inflation coming from? Why everybody be like, well, energy went up a bunch, right? Do you know that the price of oil and gasoline has gone down every day for almost 30 days, right? So the readings that we're seeing are coming from what I find to be a self-fulfilling prophecy of, oh, okay, well, the egg producers just raised prices 10% and the truckers are up higher, which has a lot to do with logistical supply chain disruptions, right? In addition to costs being higher, right? So they're raising, so let's raise, and they raise. It's like when you go to a party, and this is a terrible analogy, but I always get a kick out of this. When you go to a party in high school and somebody pukes, like at the end of the night, then everybody starts puking because they started puking. It's kind of what's going on, in my opinion, right? Could be wrong. But I just, with the prices of commodities in the toilet, I just don't see this inflation. Yes, prices are going up. I get it. But when you strip away everything and you're just looking at the core inflators, the price of semiconductors, right? Those prices are up because it's not enough foundries to meet supply, or the foundries that were producing chips are having issues, right? Can't get the copper to market. Whatever the case may be in semi land, the price of copper is way down, right? Yes, we're still having a bunch of disruptions. I imagine, catching up. But now we're moving into a position in many sectors, especially in retail, where they have an oversupply of inventory now. Now they got to dump it, right? So, as I mentioned last Saturday, it's hard to put a thumb on all of this. And, I'm given a completely different perspective than much of what you'll read out there, right? There's easily 2 or 3 hours that we could talk on this subject in terms of depth. That isn't going to do anybody really any much good, because most people that listen to this cast just want to know kind of, what's going on big picture in the markets. But again, if you don't understand what's going on behind the scenes, right? And somebody puts you in that F1 race car, and the thing is just incredibly fast. This will be like a high power trading system, or some of the algos that our developers have built, and you don't know what you're doing, you're going to crash, kill yourself in turn one, and blow your account out. So my suggestion always is, from the very basics, is to understand how it works. Okay. And by the way, actually, let me take a look at one thing. I totally wanted to bring this up. Bear with me one second. I'm actually going to. I had this on my phone. Yeah, here it is. Actually, because my son Evan wanted to. Let me just look at the order info here. Going into my purchase history to see if I can get. Yeah, that's right. He wants an education on the markets, and I choose to start him from. This is actually just bought him this book. I had this book and I gave it away to a trader, but I never got it back. But book's called Inside the House. Okay, here it is. So you can find this book used everywhere too, by the way, so you don't necessarily have to buy it new. But this is actually a really good book. It's called Inside the House of Money, and it is a good, along with, it's a good sort of like top level on what's going on from the top traders. And if you don't know what the cover looks like, let me actually, let me just go to That is Google Books. Interesting. I didn't really spend any time on this site before. I got sucked into Google Books and I didn't want to do that. Oh, here we go. Here's the cover. So this is Amazon. If you guys want, I could drop this link in Telegram. I'm going to try and give you guys a book every quarter. I'm not going to throw a bunch at you now. If you've already read this book, so be it. You can get it on audiobook if you want. Since Amazon owns Audible, you can get it for free if you set up a trial account and get the book for free. Listen to it. It's actually a really good book. It covers a lot of the top trades and sort of like the best of the best. So we're going to start the education with that. The next thing I'm going to show you guys next week is one of my top teachers in terms of just understanding global macro, starting off with a macroeconomics course, just real simple stuff, not any of the hardcore stuff you'd learn in a college course, but just the basics. I actually have a cheat sheet up on Telegram too that will cover, I don't know, probably the majority of the semester you would be studying macroeconomics all in one sheet of paper. If you could just memorize it, you'll be in real good shape. But let's take a closer look at the markets since I have deviated from the plan. All right, so S&P, see if we could take a look at this on a bigger scale. I'm sort of giving you guys my technical analysis real time because I haven't done anything really yet this morning. So a lot of times I like to show everybody what I do just live. So we have spent with the support and resistance you see here, spent a lot of time in this area. Let's take a closer look. A lot of this is going to apply to Dow 30 as well. So every time we've come up against any kind of moving average in this downturn, it's been an absolute reverser, right? If in fact we can get above this area, and that's certainly a big if, there could be all kinds of shoes dropping next week to keep us back down to this area, right? But we had a significant reversal. Well, it wasn't an outside island reversal, but it was close. So anytime you have something like that, you rarely want to be shorting into this kind of reversal because usually the next day is a face ripper for the shorts, right? Like Friday was in a big way. So usually they'll have some momentum carried off this. The key is if we can break this 3,900 level, which has just absolutely been a wall, this whole zone. Remember, it's always zones with me. It's not a particular level per se. It's always a zone. If we can bust through it, we're going to rip because there is missing notches in this previous. Yes, there's plenty of work that's been done here from a market profile perspective, but I can promise you there's some missing notches in this area. And all that means whenever you hear me say that, it is that it's an area that the market's going to just go for. Does that make sense? So because when you have huge gap downs, it leaves what's called zippers between these candles. It is an open area that was not auctioned through properly, right? Now, the pundits that are against market profile, which is few, will say, well, we did plenty of auctioning down here already. But that was a while ago. Things have changed. It's kind of like a trader land. What have you done for me lately? But I'm always looking for the gaps between these candles, especially if it's like zipper, sort of like just an emptiness zone. They will almost always, if they get past a particular support, we're just going to gun for the next area, right? Maybe try and find the next place to level off and start to trade sideways or build some sort of higher level base for a continued rip up, right? A lot of this also, I don't know, I guess can be woven pretty decently into that max pain theory I talk about, right? You always want to look at any particular market. What would be the biggest surprise? So the biggest surprise to the market is always where the max pain is. And that's typically what markets look to do if it's an efficiently traded, actively traded market, right? Like the S&P is, or the US, or the dollar euro, right? Some big currency pair. So enough about that. Let's take a look at the dollar. All right, so daily charts, full screen. Why there is not a squeeze zone right here, I don't know. But we've blown through it. By the way, for what it's worth, this is a pretty decent daily chart to, as you can see, this cup handle. See that? Now, the only thing that stinks about this is you can't see like the volume and all that. So, but if we could, and the volume was increasing as we broke out, this is a textbook buy point, right? If you had declining every time this was declining, if you had declining volume, right? Just assume the volume indicators down here. You had declining volume coming into this, then we lift it out. This could be on higher volume. Obviously, typically you want to see it higher than the average of the previous period, but on a higher volume, as soon as we get to this point, this is your buy right here. Okay. So just understand there's many different forms of couplet handles, not all work. But historically, I think I'm generally right. You can quote me by looking in William O'Neill's book, How to Make Money in Stocks. He's one of the first many decades ago to coin the couplet handle. It says like over a 75% win rate if it's done correctly. Doesn't mean it's not going to rock all the way up and come right back down to support, but ideally the squeeze zone lines, this is a really good indicator that Dasan gave me, should be somewhere in this 105.80 area. So what does all this mean for me, Steve? It means that if you're trading anything that is tied to the US manually, and hopefully some of the algos are recognizing this, we come back down to this area, should be a pretty decent area of support. Low risk area to possibly take a bounce, right? Now, if it's coming all the way down to this point, it tells you that whatever pair it's matched up with is the opposite going on, right? So let's take a look at the euro. So you're going to be right here, I would assume, somewhere against this area on the euro US dollar. By the way, for what it's worth, guys, just maybe make a snapshot of this, which I probably should do. Put it up on the wall. We're at parity, right? Crazy, huh? Or I should say we were. We got to parity. So that means $1 bought you a single euro, right? So all those European car delivery programs that BMW and Porsche do, and there's a couple other manufacturers that do that. Like, oh, it's some great deal to, go buy your car in Europe, and unless they're just making up the exchange rates from something in the past, fairy dust, right? Same price. So that's pretty cool. I actually didn't think we'd see this. So if you just look at this on a monthly perspective, which is the max we can go, and we can only go back to 94. Let's see. Let's reset the scale. Yeah, here we go. This is when the euro came about, or at least the trading part of the. So we've been down below parity before, and this was during just a really gut-wrenching period in terms of declines in equity prices here. But look where we are in relation to history, right? This isn't really anything that I guess you could take some learning points from this from a trading perspective, but do note that at least from a volume perspective, there's no volume down here, right? In terms of aggregate volume, that means that everything that traded here, which doesn't matter now, obviously, but we're in no man's land down here. There's really nothing from a chart perspective to put on this in terms of past price action, right? So all we can do, which by the way is wicked rare. I'm seeing what, once in 15, because this was a super exogenistic event here. And then once in 18, we all know it took place there. It's big correction in equities for the quarter, and everything came storming back. And this is COVID. I should say the heat of COVID. And then look where we are now. So this is the first, I actually even looked at this. This is a monthly chart. Each candle represents a month. So we're looking back like 20 years. And not only are we at parity, we're actually touching the Bollinger Bands. So this just goes to show you how far we've come, right? Maybe not a lot of learning from a trading perspective here, but we should get a lot of history lessons with me here. For this just illustrates points of extreme out, right? Anytime on a monthly chart, if you've got the right bands drawn, right, you have the right indicator on here. This is absolutely a top indicator that I use. This is an exceptionally well-written code that I was very privy to have been given. So thank you to unnamed individuals, but it's just been spot on. Doesn't mean we can't ride the bands down, right? The bands will continue to expand out if we continue to get down. But it just goes to show you from a currency perspective how far the dollar, which in my opinion is ridiculous, has come in this disruption, right? Variety of reasons for this. Most of you listening to this cast know these reasons. There's geo unrest from a war perspective there. And Mr. Putin, who's just a raging butthole, needs to be dethroned, but I don't think anybody's got the guts to pull that one off. Certainly not Biden. But there's all kinds of issues as to why we're here, right? Pandemic, disruptions, inflation, central banks shifting perspective from a long period of time of easing more than 12 years to a potentially self-inflicting gunshot to the monetary system of tightening, right? So it's a period of time where more than likely it's just not good for prognosticators, right? So the best thing to do is me not to try to be correct, right? It's to try and point out the risks associated with, or canaries, if you will, in the coal mine of, what maybe nobody else is talking about, which I don't put myself in that high of regard. So there's plenty of people talking about the shit that I am. It's just the key really is to looking for stuff that's outside of the box, like, on this particular chart. Plain and simple, dollar way too overbought, euro way too oversold, pound way too oversold, and the yen is in much, much more extreme situation. Let's take a look at that, because I have not, by the way, I can't tell you, I guess we could probably say I can tell you. No. Yes, one other period of time right here. This is back in 2008 during the global financial crisis. Look at how many times the yen, remember, we're still looking at a monthly chart, by the way. It's the highest time frame other than yearly you can go, but I choose to look at it in the 1 month clips because it really sifts out, I should say sifts through the noise. We were riding outside the bands. This is just an extreme. Remember, I told you we have a DeMark sequential setup, not only on a monthly chart, which is super rare. I mean, unicorn rare stuff, but also on a countdown, which is just sophisticated indicators that are expensive, telling us it's time to buy the yen. But it's been such a wreck. It's almost like you first, right? But from the perspective of long-termness, remember, markets can remain irrational a heck of a lot longer than you can remain solvent, right? So this is a tough trade, but from the perspective of getting the yen on like massive sale, like, actually, let me just jump back to the full screen here again. This may be one of the few times in history that it's been on this kind of a blue light special. If those of you don't understand Kmart, they used to have these blue sirens that go off when you're in the store, and there was a blue light special going on. Something was pretty funny. I've tried to get one of these blue lights from my man cave. It's been a difficult thing. In any case, that's like one for the history books, man. I got to tell you. I haven't seen a chart like this in a long time. I mean, this is just an absolute slaughter. So from the ashes, where many will sift through, I would say that if I was a bank or some hedge fund looking, that was just ridiculously freaking wealthy, I'd be accumulating some of this just from a yen perspective. Just because more than likely at some point when everybody in this global developed markets gets their act together, it's probably going to be much lower. So that is my long-term extreme out position advice. And there are ways to pick this up as I'm starting to nibble a little on some client accounts and ETFs that are currency based, since we don't trade currency in client accounts. There are plenty of ETFs that can give you exposure to that stuff. In any case, let's take a look at GBP. Back to the daily charts. Again, just bananas sold. Let's look at the all-time chart on this. Data starts with most of trading. View somewhere in the area of the early to mid 90s. So historically, this thing's never been lower. It's almost like if you're a U.S. resident looking to buy like anything from the U.K., like classic cars or anything like that. Obviously many of these prices still need to come down in classic land for a lot of stuff that's really overvalued. And if you really want a great place to sort of look at a scattergrams of prices of classic cars, there's a website called Bring a Trailer that is sort of emerged as one of the best out there in this arena. You can actually look at what's called a scattergram of prices of a car. So if you take like, I don't know, what's a really purchased car? How about like a 74 Porsche C2 911, which is like a racing version. It's about a 500 grand car. You can actually see the price of the car over the last 20 years on a scattergram, all the different ones that have sold through bringing a trailer. It's actually pretty cool. In any case, slowest it's been. So this is it. This is $1.18, 66-ish. Like at some point it's got to go up, right? It's been a long time, many years inside the zone that you see here. High side 141, low side of the zone right around 121. And we're a whole bunch of pips underneath that. So let's go back to the daily. Actually, let me just let me exit out of here. I'm going to jump to the daily chart. And weekly. And see how we're riding the Bollinger Bands down here. I actually got a question about this. I just remembered. I'll show you the Bollinger indicator here. These are the settings. So 34, you want it on the close. You want to use a standard deviation of 275. These are the styles I choose. Then these are all the numbers there. Seconds, minutes, months. So each is 52, 366 days. Remember, there's that leap year day. Hours, 24 minutes. And then the inputs here. You can actually save this as, but that's what the indicators don't really show that much. I get a question about that a fair amount, but I always forget to show it. All right, so let's take a look at GBP CAD. I always like this currency. What the hell is it? There it is. Notice we've been riding the Bollingers down from a weekly perspective. Actually, let me just go back to weekly. You see how long this range was. This is like the forever range we were trading in. We broke below it. So right in this zone here, This whole 166, look, I know we're far away from that, I get it. 166, 167, that's the big zone. But at some point, I would imagine this particular pair, certainly the yen, so yen, this pair, I think probably the euro. Yeah, I don't know the counts, but I would imagine most of these that I've shown that are just extreme outs, they're all on some sort of TD sequential countdown, meaning that they've reached a certain exhaustion level. Doesn't mean they can't go further. But at some point, those indicators from the mark are really accurate. If you guys are ever bored, you gotta dial up some old videos of DeMark. I don't know if he's been on TV much, but guy's like the best trading office ever. He has like this 20-foot ceiling mahogany office with televisions inlaid in the wall. Pretty cool. But I think these are probably all right in that arena. It's not to say you just go out and start buying these blindly, obviously, because most of the time frames I show are much, much higher than many of our group trade in. They trade in much lower time frames, 15 minutes, some cases 5 or higher. GBP, NZD, nothing going on there. I did want to show spot gold from a weekly perspective. It's really sifting through the noise, So if the economy was really that much in the toilet, why is gold heading down? Well, the person that studied macroeconomics will say, well, Steve, inflation's high. That's why gold's going down. Maybe. Maybe it really isn't that bad, right? Here's oil. Remember, there's 2 oil charts. I just show the light crude. I don't care about Brent. I only care about this one. But as you can see, we've gone down a bunch. Remember, this is a weekly chart, okay? So if you look at the daily on this, we've been going down in the oil market since the beginning of June. So almost a month we've gone just down, right? Everybody's still bitching about, this and that, and gas prices, and they've come down. It's still $4.70 a gallon here in Florida to put 93 in your car, but it's come down. So, what else do I want to show here? Currency land. Let me show. There's USD CAD. Remember, this is a daily chart. Where is Euro GBP, by the way? Bounced off of a pretty solid area. Big move, huh? Daily chart. Aussie CAD. Australian US. I think that's everything I wanted to cover. Let's take a look at crypto on the weekly. I think it tells a story. Crypto is a sore subject among many. Notice from a weekly perspective, we really have leveled off. Not the easiest to see on a weekly unless I really break this out, but here's liftoff right here. Arguably somewhere in this zone. You can see this right here where we sort of took off here. We've been to that point before. We capped out, took a while, but this is liftoff that took place in November of 20. This is ultimately where I'd like to see this land again and find support. Then you'll actually see me for the first time probably ever. Auvoria didn't, actually Auvoria did exist in November of 20, but in a previous iteration. Yeah, this is certainly a buy point right here. This whole lift out of this really sloppy, but yet long cup with handle breakout. This is ideally where I'd like to see this just rip into real quick, sort of like a final crescendo down, right? Big vol, everybody pukes, and then it starts to trade sideways. Those are the kind of patterns that you want to see play out. Those are the kind of what I like to call sifting through the ashes patterns. Doesn't mean you catch the falling knife. No, no, no. You let it settle out and trade sideways, ideally, right? Now, the problem with this is it's not based on normal trading patterns, albeit it is starting to act more like it because there is, more involvement. There's more markets to trade, and it's, sort of like more forced liquidity and scrutiny brings about typically less of the Wild West type of trading, right? Like you're trading some, low volume stock on the pink sheets in NASDAQ, right? Or something like that, which I do not recommend at all, right? Keep in mind some of the best advice I ever got in small cap or penny stock land is very simply this from William O'Neill. Low price stocks are low priced for a very good reason. And do understand that if you are a player in penny stocks, which I don't recommend, it is absolutely 100% risk capital only. Please expect to lose it all. And that the vast majority of mutual funds on this planet cannot touch a stock under $3 or $4, right? So in terms of getting institutional sponsorship, right, which is what you almost always need for any equity to come out of the doldrums, if you will, and start riding the crest, right? My favorite sailing line, you have to have institutional sponsorship, meaning the buyers, the big other time frame player, the OTF guys I talk a lot about, you have to have those players on board. So if you pick up a prospectus for even some of the wackiest ETFs or crazy ass, tech funds, most of them can't touch a stock under $3 or $4 a share. So that is my advice in both Forex, equity, and macro land for the weekend. I wish everybody a great trading week. Again, as always, follow me on Telegram or Twitter at FXES Trader. May the trades be with you.